US GDP did indeed shrink in the first quarter of this year as imports soared and spending softened. But that was only the beginning of the distortions and the payback. We also got GDP reports from Mexico as well as Europe, and a big time update from China. And you can tell how it all went by the market reaction to it. That was yields going down, oil and energy getting liquidated, and the copper to gold ratio hitting another new low. Altogether, these figures show the entire global economy was right on the precipice of payback even before getting to the real tariff shock here in the second quarter. No wonder the global financial system reacted the way it did earlier this month. American GDP fell in Q1 as imports poured into the country to beat trade duties. Consumer spending slowed and was only saved by a last-minute tariff-avoiding surge of its own. To the south, in Mexico, output growth there was very nearly zero after being down big in the fourth quarter of last year, and it too was only saved at the last minute by distortion. Over in Europe, unbelievably, Germany managed to do it yet again, running the country streak to an impressive 12 straight quarters. While European GDP overall was better than feared, you probably guessed by now that was due to artificial factors. Finally, the Chinese government has been saying that the economy there is well positioned to withstand the forgot how to grow world, remembering how to do much worse. And the latest economic data from China, however, says otherwise. The numbers worldwide were not good, and what few of them did appear to be good were tainted by future ugliness. It's the first quarter. We aren't even getting to the full tariff shock yet, so we're starting from a tough spot, and it's all downhill from here. The answer to the recession question, at least the initial part of it, is not looking very favorable. For US GDP, starting there, GDP came in at minus 0.3% quarter over quarter, which was below expectations for a small positive, about 0.3%, well down from the fourth quarter of last year, which was 2.4% quarter over quarter at an annual rate. The primary reason for the contraction, imports absolutely soared in the first quarter. Businesses from around the world shipping as much goods as they possibly can, getting it into the United States before the application of tariffs. So the overall contribution of the export sector with a huge increase in imports was minus 4.83 points off the growth rate. And the way GDP works, imports are a subtraction because GDP aims to measure what an economy produces itself, not what comes in from the outside, but what is made here locally. But a lot of those imports did make it into GDP because they went into inventories. According to the Bureau of Economic Analysis, real inventories increased by $140.1 billion in the first quarter, well up from the $8.9 billion increase in the fourth quarter as companies were cutting back on inventories. Huge increase in inventories in the first quarter. In fact, it was the biggest increase in inventories since the first quarter of 2022, back when we were in the supply shock and everybody was trying desperately to catch up with where demand was. And so that $140 billion increase in real inventories, that contributed 2.25 points to the growth rate. So putting back into GDP a little bit less than half of what imports took out of it. Now, overall consumer spending or personal consumption expenditures, those rose at a 1.79% quarter over quarter annual rate, well down from the 4% rate in the fourth quarter, which showed exactly what we saw in the first 2 months of the quarter, January and February, which was a big downturn in spending, and then not much of an increase in February. And it was saved from being even worse by the splurge in March, as a lot of consumers bought, especially automobiles, trying to front-run tariffs themselves. So even more distortions on the consumer side, as well as imports and inventories. A whole lot of tariff-driven artificiality. So you had imports with a huge subtraction, and then inventories putting some of that back, and then consumer spending, which was a lot weaker heading into March, and then saved at the last minute by the tariff-beating auto surge. When you look past all of these distortions at something like real final sales to domestic purchasers, which removes all of this trade stuff as well as inventories, it doesn't have the import surge nor the big increase in inventories. Real final sales to domestic purchasers, which is a measure of just stuff that Americans bought here, that increased by 2.3% quarter over quarter at an annual rate, which is the lowest rate since the fourth quarter of 2022. And because it contained a whole lot of front-running purchases, Even that low rate isn't going to hold up in the second quarter and beyond, especially given all the forward-looking indicators in terms of consumer confidence and PMIs and everything else. Looking at real final sales of domestic product, which is anything that's produced, goods or services here in the United States and sold regardless of where it's sold, including exports overseas, that one dropped by 2.5% quarter over quarter annual rate. It's the first decline in real final sales of domestic products since the first quarter of 2022, the technical recession. It's no longer a technical recession. It's since been revised. And it's the biggest drop in domestic product since the second quarter of 2020. So because exports were weak, consumer spending was not all that robust as some people are trying to maintain, real final sales of domestic product came in deeply negative. So as positive as it might seem that you get past the import surge and the GDP accounting related to it and say, okay, without the import surge, GDP might have been somewhat positive. Then you look at real final sales of domestic product, deeply negative. That's a negative indication of demand, especially given how much artificiality there is in that, just keeping it from getting even worse. So we've got distortions all over first quarter GDP, yet there's some positive distortions that were adding to GDP. There were some negative distortions taking away. And the net effect was basically what the first quarter GDP numbers showed, a small contraction, 0.3%. That shows how the economy was weak and fragile even before we get to the worst of the tariff shock. As I said in the intro here, it's all downhill from this point. So what we'd expect for second quarter and beyond is that imports are going to come down from that big, huge high. And so they'll add to second quarter GDP as they do because of the way GDP accounting works. But inventories will also come down, though probably slower than imports will. So inventories coming down will subtract from GDP. While consumer spending, that's likely to slow. That's what all the forward-looking indicators are coming to, the conclusion they're coming to. So the question with consumer spending is how much it's going to slow from here. How much was front loaded, how much the payback will be. Same thing for business investment. Business investment in the first quarter was huge, but that was artificial. How much will that reverse? How big will be the payback there? And so this is where markets are instructive because they're not looking at all these results in a constructive fashion at all. So for all the distortions in the first quarter, again, looking forward, it gets uglier from here as the actual tariff shock hits and we see the full nature of the fragile economy. The one that forgot how to grow starts to remember how to do worse. And a couple other reminders came up in the U.S. data today. ADP's employment report for the private sector only increased by 62,000, while ADP isn't exactly the most reliable statistic. Still 62,000, lowest since last summer, well below expectations of around 120,000. It suggests that employers there are looking more cautiously at adding new employees. And again, this is one of the more optimistic takes on the labor market that's there. So if one of the more optimistic takes on the labor market is starting to look weak and ugly again, like it was last summer, that's another red flag. As was a marching band full of red flags in the monthly PCE numbers, or personal consumption expenditure, the deflators, the price estimates, the ones that the Federal Reserve uses. The month-over-month change in the headline PCE, like the CPI, was fractionally negative. But it was fractionally negative by the most since the middle of 2020. What that shows us there's not enough demand for all of these goods and services that were flooding into the country trying to beat tariffs. And so you have the biggest negative, even if it was fractionally negative, the marching band of red flags that says distortions, imbalances, not in the economy's favor. From there, we move to Mexico. Mexico, another big topic for where it comes to trade wars and everything else that's happening more recently. Even before we got to trade wars, though, Mexico's GDP was incredibly weak in the fourth quarter, falling by 0.6% as Mexico fell into the payback period, the global recession that was developing. Forgot how to grow was forgetting even more in Mexico than almost anywhere else. In the first quarter of this year, while expectations were for flat GDP, basically stabilizing after the big drop, GDP came in at positive 0.2%, so really not much different from the 0% expectations, especially in light of the 0.6% drop in the fourth quarter. But the details, they suggest a lot of caution, a lot of weakness, and more contraction up ahead for Mexico. Mexico was saved from this technical recession or 2 straight quarters of negatives simply by a surge in agriculture and a surge of agricultural exports, which are not going to be repeated moving forward. Meanwhile, industry was down 0.3%, while the services economy in terms of GDP was flat. The decline in industry as well as the flat reading in services, that's with all the front running that we've seen. So industry was still contracting with all that artificial positive activity, trying to get everything done and made and shipped out before the tariffs actually hit. So what's it going to look like when we get into the payback period? To ask the question is really to answer it. So Mexico already in trouble in the fourth quarter, got a little bit of a temporary boost in the first quarter, just enough to keep GDP barely positive, and then it's all downhill from here. As Bloomberg reported, where it came to Mexico's results, although manufacturing output was weak, exports were strong, with U.S. importers bringing forward orders to dodge more punitive tariffs on Mexico's goods, which just means payback still coming. Mexico's central bank recently cut its 2025 GDP estimate in half to 0.6%, while a Citi survey of analysts pegged it lower still at 0.2%, down from 1% in February, and the IMF, as I noted before, has it at minus 0.3% for all of 2025. As Bloomberg continues, the weak first quarter GDP will reinforce the central bank's concerns about the healthy economy, as anyone with common sense would say the same thing, which currently appears to be playing a more prominent role than inflation for policymakers. This should pave the way for another 50 basis point rate cut at Mexico's next meeting next month, which is another key point, another key entry in the global race for the bottom as far as central bank policy rates joining their market counterparts, which have been pricing this eventuality, this direction, this entire time. Over in Europe, GDP for the Euro area managed to beat expectations too. Again, artificial surge in activity into the first quarter, but it was only a modest beat and only a modest 0.35% quarter over quarter increase. That's not an annual rate. The annual rate was just 1.4%, which shows how lackluster this was, especially given all the artificial positives that the European economy benefited from in the first quarter, if you want to call it that. Germany, if you recall Germany, ever since the first and second quarters of 2022, Germany has been back and forth by quarter, every single quarter since then. If there's a negative quarter, it's followed by a positive quarter, which is followed by a negative quarter, which is followed by a positive quarter. It's something that I don't think I've ever seen. I don't think anybody has ever seen as far as any GDP statistic in any country. It has ever produced something like this back and forth for 3 solid years. Now, on the one hand, it has allowed the German government, the German economy to avoid the technical recession. But on the other hand, it doesn't actually matter because back and forth, small negatives and small positives over the course of 3 years is an enormous negative, an enormous contraction. So regardless of the spectacle of back and forth for 12 quarters, the upshot is Germany is in deep trouble, and so is Europe. You don't get caught up in these small numbers with a positive sign or a minus sign like Europe overall. Instead, realize how far off trend GDP is and how weak the economy must be for something like that to happen. That's really the message from GDP. Even if it's gone back and forth for 12 straight quarters, what it shows is that fragile economy even before we get to 2025. And as CNBC adds, Eurozone economic growth has been lackluster for much of 2023 and 2024. That's how they put it, lackluster. It's actually been an enormous contraction. Even as the European Central Bank has been cutting interest rates in an effort to stimulate growth and boost economic activity, which just goes to show low interest rates are not stimulus. They are a reaction to the weakness that CNBC is trying to describe in its own mainstream terms. The ECB's deposit facility rate, its key rate, was taken down to 2.25% earlier this month, down from highs of 4% in mid-2023 because, as I said, central banks react to weakness, especially persistent weakness, in the only way that they can, by lowering their policy rates, which simply reflects the economic weakness that convinces them to lower their rates to begin with. And market rates want to go down, not because central banks are going to lower rates or that it's stimulus. Market rates go down as lower growth and inflation expectations not only seep in, they solidify in the marketplace. So even in Europe, you got 0.35%, a 1.4% annual growth rate in the first quarter with all this artificial activity boosting it, which means that's the best that you're going to see from Europe, and it's all downhill from here too, which is what all the forward-looking indicators across the European economy are suggesting, including some really dire sentiment numbers that came out from the European Commission this week as well. All of it saying that this is the best that Europe can hope for the rest of this year, and it wasn't all that much to begin with, like in the United States and in Mexico as well. And finally, China. China reported its PMIs for manufacturing, non-manufacturing, and the composite, and they were much weaker than expected, though it should not have been unexpected given the fact that we're talking about artificial high and payback with China right in the middle of all of this stuff, right in the middle of trade wars. China's manufacturing index came in at 49, which was down from 50.5 back in March, and it was expected to only decline to 49.8, so well below expectations. And 49 for China's manufacturing index is one of the weakest numbers in the entire series. That's the worst since December of 2023, and one of the reasons why, not surprisingly, the export order index fell to 44.7, which is the worst for that in 11 months, with also forward-looking indicators suggesting it's only going to go further downhill from here for China's export sector, as well as its manufacturing and industrial sectors too. I mean, after all, China has been dumping its goods on the rest of the economy to begin with, and also front-running the tariff restrictions. So there was going to be payback in the Chinese economy regardless. And so the first look at it here in the month of April, not so good. In non-manufacturing, the non-manufacturing PMI came in at 50.4 for the month of April. That was down from 50.8, and expectations were that it was supposed to be stable around 50.7. But more importantly, the non-manufacturing PMI shows that this year, unlike almost every other year in Chinese economic history, there was no post-holiday Golden Week spike, as there usually is in either February or March. You look at March of this year, the index got only as high as 50.8 compared to last year, which wasn't all that great, just 53. So 53 in March of 2024 is the post-holiday high, and only 50.8 here, and already that index is rolling back over and heading lower. For non-manufacturing and services, which have been struggling for the last several years, despite the Chinese government's best efforts to try to support consumer spending, to try to get service spending up, and to make that part of the economy function in a way that the Chinese really need it to. In fact, the rest of the world does. But we still see no evidence from all of the stimulus that the Chinese government has been doing over the last couple of years. But not according to the Chinese government. As Reuters reported, the readings on these PMIs contrast with Chinese officials' conviction that the world's second largest economy is well placed to absorb the U.S. trade shock, and instead suggests domestic demand remains weak as factory owners struggle to find alternative buyers overseas. And that's, I mean, everyone says their economy's fine. Everyone says their economy is going to be able to weather the tariff shock, and everyone is wrong because, first of all, the entire global system was fragile to begin with, not strong and resilient, not heading in the right direction, not on its way to a soft landing. It was fragile. The warning signs were there all along. And so now that we're getting into the payback period, what are we seeing? It's confirmation that there is a global payback. It is only beginning, and the beginning of that payback is among the worst cases. So you have US GDP. It's negative and it's distorted, but there's also genuine weakness in it. So what kept it from being worse without those negative distortions were more positive distortions, so that overall the US economic picture for the first quarter looks a lot like what the headline says, a small contraction as the first step toward the tariff shock and the paybacks. So forward-looking, all the indicators that we've been discussing lately, they're not looking good. So we start off on the wrong foot, and it goes downhill from here. Mexico was already in trouble and only modestly alleviated their fourth quarter decline by an agricultural surge that isn't going to be repeated, and a whole bunch of front-loading and distortion there as well. There's going to be a payback, and a big one in Mexico. Germany, at this point, what the hell is going on? Back and forth, but either way, it doesn't matter. Germany, as weird and inorganic as the GDP numbers look back and forth by quarter, it's still a perfect example and representation of fragile, forgot how to grow. And in the first quarter of this year, both Germany and Europe as a whole, also artificial front loading, and all they got for it was another weak, lackluster quarter. And finally, China, the dimming prospects in April as the payback period begins over there. And while the Chinese government is sanguine, at least outwardly, The markets aren't, and there's no real reason to be, the information that we're getting from China confirming the downside case. So what does all this information show? It shows that in the first quarter of this year and the first part of the second quarter, the economy really was in bad shape. It was already fragile. It was already forgot how to grow. And as it heads further into the payback period, as well as further into the tariff shock, that forgot how to grow economy really is looking like it's about to start remembering to do much worse. So as far as the recession question goes, the recession question, the initial answer to it, not favorable. What also really isn't favorable, all these forward-looking indicators, a lot of them coming from the Federal Reserve itself, including scattered reports of layoffs in the US. I went over all of that in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and Eurodollar University subscribers. And until next time, take care.